You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. The Securities and Exchange Commission says it is fast-tracking President Trump's proposal to change the required frequency of corporate earnings disclosures. The president and other proponents say that changing the requirements from once every 3 months to once every 6 months will reduce the costly efforts that go into putting together these reports and encourage longer-run growth by freeing executives from decision-making centered on quarterly targets. Opponents of the proposal argue that quarterly frequency is important for corporate transparency and ensures markets function smoothly. On today's bonus podcast episode, we talk with Nell Minow, corporate governance scholar and chair of ValueEdge Advisors, about the history of quarterly earnings reports, how regulators determine materiality, and the timeline for any potential regulatory changes. Stay tuned. Our guest today is Nell Minow, a corporate governance scholar and the chair of ValueEdge Advisors. Nell, thanks for coming on the podcast.
I'm delighted to talk to you.
Our interview today will be focused on corporate governance, specifically some ongoing efforts to change disclosure requirements of publicly traded companies and how potential changes could impact financial markets. Now, Nell, give us some background on how things stand right now. What do current regulations stipulate about what public companies must disclose in their reports and how frequently about their performance?
Since 1970, so for more than 50 years, the SEC has required companies to make quarterly disclosures. So that's by their own quarter, by their own fiscal year. And they've got to basically disclose, this is the key word, whatever is material. And that's anything that an investor might want to know. And there's always a huge tension between what companies think investors want to know and what investors want to know. And since my entire career has been working on behalf of investors, obviously that is my bias. But I am a graduate of the University of Chicago Law School. I am a passionate believer in free markets, and I've started several businesses and created jobs. And so my view is that it should be the shareholders who decide what is material. Probably the most extreme case I can think of is I got a call from a reporter once that said that the CEO had died and they had not disclosed that in their quarterly report. And when they called the company and said, "Don't you think that's material?" They said, "Well, it was in the newspaper, so we didn't really feel like we had to include it." But yeah, you want anything that might affect the future performance of the stock. So whether that is the SEC is investigating us, or, understanding that certain things are proprietary and don't need to be shared with the world until it's time. But if there's some kind of an opportunity coming that might benefit the stock. So anything that's material. And that is a word that has been fought over now for more than 50 years.
Yeah, that's an interesting, albeit a little dark example that you gave. So I'm curious, since this started in 1970, has there been a lot of back and forth about what constitutes material? Is the SEC pretty vague about it and it comes into a case-by-case basis? Have there been efforts to reform?
Exactly. The idea is that it should be kind of vague, and they feel the same way about the term insider trading. They're not going to give you a definition because there's no way for the human mind to anticipate every possible way that this could play out, and particularly in the future. I mean, you don't know what is going to be invented. You don't know what new rules are going to be passed by other regulatory agencies, and so they purposely keep it vague so that they can decide on a case-by-case basis. And then here's another vague word for you that comes into play. Material that would be considered material by a reasonable investor. So what does reasonable mean? That is also a word that is subject to a lot of interpretation. And I think the best way for me to say it is that it's the kind of information that would normally be considered relevant in making a buy, sell, or hold decision.
And so to go back to my original question, this disclosure, it comes up quarterly, but if something really material happens in the middle of the quarter, they have to disclose it. What happens at the end of the quarter, and what has to kind of be reported immediately, in a sense?
So if the SEC does investigate you, if somebody buys a huge block of stock in you and you may be considering adding him or her to the board, those are things that you want to hear about immediately and not in the newspaper. You want the company to reveal it. And the reports must include unaudited financial statements. That's the income statement, the balance sheet, and cash flow, management's discussion and analysis of results. And again, that is open to interpretation. You can say, well, here it is. You've got it. I really have nothing more to say about it. So it applies to all publicly traded companies. The form is known as a 10Q, and it's an overview of the company's financial performance over the past 3 months. So that's where you get a chance to decide, say, for example, if there's stuffing on inventory, maybe you might get a clue there, and that would help you make a decision about whether to continue to hold the stock.
So you bring up the newspaper example where some big news, might be pretty public anyway, and so why does the company have to go through with it? And I am curious, considering how quickly information flows these days, do earnings reports give much new information to investors? By the time that earnings report comes out every quarter, are there any big surprises, or throughout those 3 months, have a lot of the most important things impacting company performance already been pretty evident to the investment public?
My view is on the side of the investors, and by investors, I'm talking about large institutional investors. That's where I do my work. And so I'm not talking about mom and dad who might be trading stocks, but that's a very small group, as you know. Most individuals invest through the people I deal with, the index funds, the mutual funds. If you think about it for a minute, you can say, well, everything's on the internet. Why isn't that enough? Well, there's a lot of garbage on the internet. You want two things in the quarterly reports. You want to know what the company thinks is material. Maybe you disagree, but just understanding the perspective and the transparency of the management, I think, is in itself very, very worthwhile. And you also want something that's scrubbed of all of the noise that you get if you just are looking everywhere.
So I see some room for potential self-regulation. And what I mean by that is, if investors really do want more frequent disclosure and corporations don't provide it, then investors could signal that through the market. Maybe they need a concession on corporate debt or a discount on equities. And then the corporate governance, the people in charge would say, well, we want lower borrowing costs. We want our stock price to go up. Let's increase the frequency of our disclosures. So couldn't there be a self-regulating mechanism here where it doesn't have to be up to the SEC and it's within companies' own best self-interest to actually have frequent disclosure?
I'm a big fan of free and efficient markets. So sure, you don't have to negotiate a discount on the stock. It will just appear because the companies that continue to be very transparent, as they are now, some companies do better on disclosure than others, and some companies get punished tremendously by coming out with misleading comments in the quarterly reports, and then they get sued and they have to pay a lot of money. Their D&O liability insurers have to pay a lot of money. Sure, I can tell you right now that if this goes through the SEC and they do go to biannual, then the companies that say, you know what, we think it's a very good discipline and we like to communicate very transparently with our shareholders, we're going to continue to go quarterly, they certainly will get a premium on the stock.
That comes back to my original question, though, which is, why does it matter if the SEC changes its rules if the market can punish and reward companies that disclose more, no matter what the SEC rules say?
Before I was working in this field, which has been most of my career, I spent 8 years in the government. I was in the government during a period of intense regulation and intense deregulation. So I have, like Joni Mitchell, I've looked at love from both sides now, and I can tell you that one of the most compelling justifications for regulation is the collective choice problem, which is that, you can't say, well, let every car manufacturer have their bumpers at whatever height they think is good, and we'll let the market sort it out, because there's no way that the market could possibly make that efficient so that when our cars slam into each other, they have the greatest amount of protection. So I feel that way about financial reporting as well. Yeah, the market would sort it out, but I don't think that's good for the economy or for the markets.
Do you think that the at least market requirement or the need for this disclosure every quarter, every 6 months, all of that can vary by company or industry? So maybe investors or just the nature of certain sectors, investors are pretty open to saying, you know what, we'll give you some more time. We only need it every 6 months. Maybe you are a very trusted company. Maybe your line of business fluctuates so much within a quarter that we're going to extend it to 6 months. Could there be any room for tailoring the regulations depending on what type of company or industry we're talking about?
Well, of course, that goes to the issue of materiality. If you're in some kind of a company that's not cyclical, that's very reliable, then you're going to decide what's material in your quarterly reports and let the market decide whether they think that that's adequate. But I don't think so. As my boss, Ronald Reagan, used to say, trust but verify. And what makes a company trustworthy are the disclosures, not disclosing.
I'm curious what you think we can infer from international examples to predict how the change could impact corporate governance in the US. So I believe that the UK and Australia, other advanced economies do require this semi-annually rather than every quarter. And you touched on it a bit earlier. Is it just in addition to the difference in frequency requirements, there's also a difference in the type of information companies need to disclose? How can we look at those examples to understand what could go better or wrong in the US from a change like this?
Well, they have different accounting standards too. And I think you got to be really careful about comparing the U.S. economy to other economies. You take a country like Italy, they've got maybe 90 publicly listed companies. We've got, 12,000? The reason that our economy has consistently been the strongest and most robust since the 1920s, since the stock market crash, is that our first SEC chairman, who was Joseph Kennedy, the father of John F. Kennedy, when he was first appointed, they said, wait a minute, he's a Wall Street guy. Why should he be the regulator? And Franklin Roosevelt said, it takes a thief to catch a thief. I'm not a huge fan of Joseph Kennedy, but he said, we're going to make it all about disclosure. That is the single factor that has made our economy so strong, so robust.
This topic really came to the forefront via a social media post, as certain policy changes come to be these days. But let's talk about the process for changing these rules. Can it happen unilaterally with the stroke of a pen? Does it require Congress, a long review process? What should people expect in terms of a timeline for how these regulations would change and the process it would go through?
The idea of legislation is that if the people don't like it, they can vote the congressman out. The idea of regulation, which is what this is that because we don't have that opportunity, we don't have that kind of sort of market accountability that we do with elected officials, we have the equivalent, which is called notice and comment. That means that before any regulation is issued, the regulatory agency, whether it's an independent commission like the SEC or part of the executive branch like the Environmental Protection Agency, has to publish a rough draft and say, we welcome all your comments. We want to hear good, bad, indifferent. You tell us how to fix it. And sometimes, you get 8 comments because it has a very narrow effect. Sometimes you get thousands of comments. In rare cases at the SEC, they will actually have a hearing to hear more about it. And that process obviously takes quite a while. Furthermore, more recently, with some of these things at the SEC, they've gone to court. They're still in court right now over Trump 1 era regulations because, courts, they're not famous for moving fast. So I do not expect to have anything happen very soon. What we will wait for is some kind of a proposal coming from the SEC, and then we will have an opportunity to file comments. And my expectation is that the shareholder community, and I'm talking about the big guys, the California Public Retirement System, the New York City Retirement System, BlackRock, Vanguard, will write in and say, nobody needs this, don't do it.
You have certainly made it clear that you're skeptical this would get passed and there would be enough of a kind of lobbying effort to make sure that the status quo is maintained. But does the SEC need to really listen to these public comments? I mean, we've seen sometimes the executive branch will just use its brute force and say, we're really in support of changing this policy and we're going to go through with it. What sort of mechanisms are there in place to stop the people at the SEC from changing the rules no matter what those public hearings say?
That is such a good question because the law on that is changing. The Supreme Court issued a ruling last year that overturned decades of law, which said that the courts would give a lot of deference to the expertise of the federal agencies. Now it's just anybody's game, no rules. So either way, it's going to get challenged, whether it stays with the status quo or it doesn't. It's going to get challenged. And that's why they're going to have to dot every I and cross every T in the way they respond to the comments. If they just ignore them, that's not good enough. So when it does get challenged in court, the SEC is going to have to be very, very careful if they want it upheld to respond to the comments in a substantive way.
What would be your regulatory prescriptions in terms of finding the right balance between corporate transparency and, some of the hindrances that are often associated with it? There has to be some sort of balance, right? We don't require companies to disclose every week, every month. So what do you think is the right balance there? Or is the status quo something you think is really striking it pretty well?
I think it is striking it pretty well. And the fact that there are earnings calls, which are not required, shows that companies realize that this is a worthwhile discipline. And I do think that the words materiality and reasonableness being subject to interpretation are a good way of sort of taking the temperature of this and making sure that there's some kind of cost-benefit analysis involved in making the disclosures.
Nell Minow, thanks for coming on the podcast.
My pleasure.
This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.